we are doing that chapter options in derivatives, in which last class we started discussing about the option valuation models. Please settle down. Settle down. We started discussing about option valuation model, in which we did one sum in the binomial model of option valuation. We have to discuss some logic behind the binomial model. Once we complete that, we'll discuss today risk neutralization model, two-period binomial model, and then Black-Scholes model for option valuation. If we have time, we'll enter into theoretical boundaries of option with dividends given in the problem. Okay, option valuation with dividends will be the next stage of discussion. If we have time, we can have an introduction about that particular concept also. Please stop talking. Request. Once we complete the option valuation with dividends, we have only one more concept called as American options. Probably Thursday we'll be completing the chapter options and then start with the next area called as futures. Now let us summarize what has been discussed in this option chapter before we proceed further. Number one, option is a contract between a holder and a writer. A call option gives its holder a right to buy an underlying asset at an agreed price called as strike price on a particular date called as maturity date. The put option gives its holder a right to sell a particular asset called as underlying asset at an agreed price called strike price on the maturity date. Writer of a call option is having an obligation to sell. Holder of a writer of a put option is having an obligation to buy. There are three prices for the underlying asset: spot price, strike price, and then the future spot price. Price at which the underlying asset is trading today in the market is called as spot price. The agreed price for a future transaction today we call as strike price. And the actual price at which it is trading in the market on the maturity date we call as future spot price. The option will be exercised or lapsed by the holder. He will decide by comparing the future spot price with the strike price. If FSP is more than the strike price, call option will be exercised. Applying a mind or not, he has a right to buy at a lower strike price, a share worth higher FSP. Hence FSP more than strike price, call option will be exercised. When FSP is less than strike price, put option will be exercised, because he has a right to sell at a higher strike price, a share worth lower FSP. Other words, in other way, the options will be lapsed. When an option is exercisable, it is said to be in the money. Option is lapsed, it is said to be out of money. Indifferent, it is said to be at the money. These options can be of two types, namely American and European options. What we are discussing are all European options only. European options can be exercised only on the maturity day. American option can be exercised anytime during the maturity day. Both options, the holder pays a writer a price for the option. That price for the option we call as option premium, even called as option value. Value of an option is the premium which we pay for that particular option. We discussed basics in options, where we saw what is break-even FSP. Break-even FSP is the FSP on maturity date at which the option holder earns nothing. It is given by the formula strike price plus premium for the call option, strike price minus premium for the put option. Then we discuss about option strategies. We can just take a combination of positions in call and put options to create a payoff patterns. Those are all called as option strategies. Namely, we discuss about long straddle, short straddle, long strangle, short strangle, bull spread with call option, bull spread with put option, bear spread with call option, pair spread with put option, butterfly spread, etc. There are so many other option strategies also. If we just go to the Investopedia, in what net, we can see so many option strategies. Like we have a condor spread, we have box spread, and so many, that is covered call, covered put. So many strategies are there. For just information sake, one can go, we know how to read the strategies not. If you can just understand that, they'll give you along with the diagrams and shapes. There are so many other option strategies. We are not discussing for two reasons. Number one, it is not worth discussing because simply again we're going to find out the payoffs and see the patterns only. That requires observation, not the teaching in the classroom, right or not? The second reason is these spreads are only very regularly asked in the examination. That's the reason why I have not discussed option strategies. There are around say 15 to 16 strategies that is available in the net. These strategies are frequently used by traders to trade in the option where they earn in some cash flow patterns. Everybody following or not? Next. Then we discuss about the next small concept called as short selling and then continuous compounding. Short selling means selling the share today and buying the share later. Without holding a share, sell the share today and then later buy the share. How it is possible? Borrow share and then sell. Later buy the share and repay the lender of the share his shares. This is what we call as the short selling. We'll discuss this more when we discuss options with dividend later. Continue, and we said call option mainly derives the value only due to the short selling possibility. We saw the strategy also, short sell a share and then what? Hold a call option is a very natural strategy. Can you see? Next. Then we discuss about the next area, the theoretical boundaries of a call option and put option. What can be the minimum value of a call, minimum value of a put? What should be the maximum value of a call and maximum value of a put? Very regularly asked examination time. Tell me, minimum value of a call option, what is the formula? Spot price minus present value of strike price. What is the minimum value of a put option? Present value of strike price minus spot price. What is the maximum value of the call option? Spot price. What is the maximum value of the put option? Present value of strike price. Maximum value will never happen. Rarity, great fool only will be trading in what? Such value. But minimum is generally possible. Above that only we have the arbitrage discussion. Can you see? Now, minimum value of a call is spot price minus present value of strike price or not? If actually in the option market we see the call option trading at a premium below the minimum value, then what we will do? We will go for an arbitrage strategy. Tell me the strategy. Hold the call option and then what? Short sell the share. If the actual value of the call is more than the maximum value of the call option, call is overpriced, what is the strategy? Write a call and then buy the share today. Yeah, right or not? The write a call, buy the share today we discussed. Other we have as a portfolio in the binomial model. Write a call, hold the delta shares. Now, next is third strategy is when the put option value is below the, let's say, the minimum value. Tell me, put is overpriced, underpriced, underpriced. What I should do? Buy the put option and then buy the share. Or hold the put, hold the share is the strategy. Right or not? And if the put option is above the maximum, one or two strategies, one. What is the strategy? Write a put option that is more than enough. You have seen how the arbitrage profit should be made. Once that is discussed, then we move on to the next discussion called as put call parity equation. What we discussed is there are three assets which can be seen in the market or three securities that can be seen in the market. What are three securities? Share of a company, option on those shares which can be call option as well as what? Put option. So share is traded in the share market. Options are traded in the F&O segment where we have call option as well as what? Put option. What the put call parity says is that if the two options, call option, put option, is written on the same share, is having the same underlying asset and they have the same strike price and they have the same maturity period, in that case the share, the call option price, the put option price should satisfy a parity. Call as what? Put call parity. What is the put call parity? VC plus present value of strike price is equal to VP plus VS. VC means value of the call today. VP means value of the put today. What is VS? Value of the share today. So all these three prices can be seen from the options and share market. Take those prices and put it into this equation. The equation should tally. If the equation doesn't tally, what happens? Arbitrage exists. How to make the put call parity arbitrage has been done in two ways. Okay, where portfolio A is undervalued, where portfolio B is undervalued. Both ways we done a put call parity problem. And if I remember, my memory is right, I gave one problem as homework. Yes or no? Yes, sir. Those who have done that sum, raise your hand. What happened? As usual. Okay, please. Try it. Now, I can say one thing. You are understanding this. These chapters at the time of learning may be a little bit difficult. No scope for original thinking. No scope for what? Original thinking. Everything has been what? Structured and what? Given to us. You need not have an alternate solution. The solution is what? Same for everybody. We have the steps predefined. Yes or no? If we master that chapter, there is less uncertainty in the examination regarding answering these questions. I think you are all understanding it or not now. Please spend time. Shh, please. I also said you should be revising and coming throughout the derivative segment. One should be having a consistent revision process. I will be lost in that discussion sometimes. Okay, can I proceed? Now, once we completed the put call parity discussion, I said put call parity arbitrage may exist. They may ask another type of problem where they give you two values and ask you to find out the third one, balancing figure problem. And all option valuation models will be satisfying the put call parity equation is what we have discussed. Now, then we started discussing about the option valuation models, please. Now, see, till put call parity, we did not value an option. We discussed about the option value, we did not what? Value an option. We said an option value should not be below this. An option value should not be above this. Option values, call, put, share price. If I put, it should satisfy what? Parity. Okay. So, in that case, I am not cornering one value for an option. I am only saying it should not be like this, it should not be like that, it should be satisfying all these things. That is what we said. We did not get into the mode of what? Valuing an option. Share, we had a valuation model, yes or no? Gordon model or Walters model, etc. Like that. We wanted a model to value the option. The model may be right or wrong. That is, what we get may be ultimately right or wrong, because valuation is all about future only. Nobody can predict future what? Accurately. But there should be a method of valuing the option. So that was very elusive for most of the researchers for a very long time. And then they started finding out models for valuing the options. Where we have four models, namely binomial, risk neutralization, two-period binomial, and then Black-Scholes model. We had a very basic discussion that was very important to understand the logic of the models. The discussion is, option when a value, the cash flows can be understood with the help of the FSPs. But the problem is the discount rate, because unlike any asset, value of an option is what? The present value of the future benefits. So in that case, I have to discount it. So the discount rate was a problem. The reason is, I cannot discount using a risky rate, because option derives the value from the underlying asset. The underlying asset is already discounted for what? Risk. I should once again not discount the option for the risk. So in that case, everybody agreed that we should be discounting the options only using risk-free rate. But the problem is, if I want to discount using risk-free rate, the cash flow discounted should have no standard deviation. Should have what? No standard deviation. Standard deviation measures what? Risk. No standard deviation means what? Always it is the same number only. It should not change. For example, a call option may be lapsed, the value can be 0 after 3 months. Exercise value can be 11. In that case, 11 also can happen, 0 also can happen. So what you will normally do, you assign some probability for what? 11 and 0 and find the expected value to discount. Yes or no? In that case, when you assign probability, then the expected number will be having a standard deviation or not? When I have a standard deviation, then I should be having what? A risky rate to discount. I cannot use a risk-free rate. Everybody understanding it? Now, now, so if it is 11, FSP is 100, it is 11. FSP is 98, it is also what? 11 means always 11. The mean also will be what? 11. Sigma will be what? 0. I can discount at what? Risk-free rate. Everybody understanding it or not? So, if I have to use risk-free rate, the cash flow which I am discounting should be what? Certain. You should have what? 0 sigma. Should be having what? 0 standard deviation. That was not possible for an option because option can have various possible values on the maturity date depending on the FSP. Yes or no? Now, then you cannot say, so then let us discount at what? Risky rate. There is also a problem because that comes only from what? The share price. It is already there in the spot price. The risk has been discounted. Everybody following now, in that case, how to manage risk only, they started tackling some really good models or ideas came. One of the model which we finished discussing in the yesterday's class is what? Binomial model. Some discussion has to be made regarding the steps in the binomial model. Let us complete the discussion. Do one more problem in what? Binomial model for our grip, okay? And then go for the next area called as risk neutralization model. Now, till now, Kadar chapter, are you following or not? We are doing it very elaborately and very deeply. Are you following what I am saying? Now, next. Let's go to the next. Binomial model. Just to have a flow, we'll summarize the previous discussion. I think I've copied the solution. We'll summarize it and then discuss 2 points in the binomial model before I go for the risk neutralization model. Everybody, can we start up? Now, see. I think we are doing question number 22. Question number 22, please. Now, let's quickly summarize this binomial model problem before I proceed further. Now, stop talking. We did 22A. All of you participate. I'm just revising for you. What is spot price of the asset? 100. That is where you get this number? Share market. Today, the share of this company is trading in the market how much rupees? 100. What is strike price? Where it can be seen? In option market, they give the option contract terms or not. The term of this option says what? Strike price is 97. Please, let's assume this as a call option, strike price. Now, FSP, that is the possible future spot price on maturity date, can be 90 or 108. It is not 90 to 108. It is what? 90 or 108. Binomial can take only 2 values and not a range of values. Can I proceed? Please. And the term of the option is 3 months. The interest rate is 12%. This is all the details given. Okay. Now, tell me, binomial model we discussed with the portfolio. We discussed with what? Portfolio. Can tell the portfolio assumed by the model. Write a call. What is the portfolio? Write a call and hold delta shares. You can tell me the portfolio. Write a call and hold delta shares. Delta means some number of shares. Okay, we have to find out in a step 2 later. Tell me how many steps are there? 6 steps. Tell me what is step number 1? Change in value of call and change in FSP. Step 2 is what? Delta shares. Formula is what? Change in value of call divided by change in FSP. Step 3 is what? Future value of the portfolio. Step 4 is what? Present value of the portfolio. Step 5 is present value of delta shares. Step 6 is the value of the call option. Respond is or no? Now, let's once again redo this problem quickly. No need to copy, just participate now. Okay. Step 1 is change in VC and change in FSP. Here the word value of the call means the value on the maturity date. Yes or no? Because that if I discount, I get the value today. Can I proceed? Now, situation 1. FSP can be 108 or what? 90. Suppose FSP is 108. You are a holder or writer. Now our portfolio is writer call na. You are a holder or writer? Writer. You will decide, other party decides. He is having a strike price of. What is strike price having a? 97. He is having a strike price of 97. The other party is having a right to buy at 97. A share worth what? 108. Will he exercise the right? Yes. For him the value is what? 11. For me the value is what? Minus 11. Because I lose 11 rupees because I am forced to sell at, I am forced to that is sell at 97. A share worth what? 108. Am I right or not? No. Second case, suppose the share price is 90. Will my holder exercise or lapse? Lapse. So what is the value of the call to him? 0. My value also is 0. Now the FSP change is how much rupees? 80. The call value change is 11 rupees. Point number 1, accepted or not? Now, step 2 is what? Delta shares. Tell me what the formula for delta shares? Change in VC divided by change in FSP. Tell me the number here. 11 divided by 80. That gives you how many shares? 0.6111 shares is the delta shares. Am I right or not? Now, step 3 is what? Future value of the call option. Okay, future value of the portfolio. Now, in my portfolio, how many items are there? 2 items. One is what? Call writing. Another is what? Shareholding. I am holding 1 share or 0.6111 shares. 0.6111 shares. Okay. On maturity date, let us see the worth of my portfolio. First is situation 1. FSP is what? 108. When FSP is 108, if I hold 1 share, what is my wealth? 108. I hold how many shares? 0.6111 shares. On after 3 months, my wealth is how much here? 66 due to shareholding. Yes or no? No. I'm also writing a call or not. Will other party exercise or lapse? Exercise. He'll be having what? 11 wealth. I'll be losing what? 11 rupees. So what is my overall wealth after the 3 months? It is going to be 55. If the FSP is what? 108. No, sir. FSP is not 108. FSP is what? 90. In that case, if I hold 1 share, what is my wealth? 90. I hold how many shares? 0.6111 shares. What is my wealth here? 55. The call is worthless. The portfolio value is 55. Respond yes or no? No. Whether the FSP is 108 or the FSP is what? 90. My portfolio gives me what? The same value of 55. The future value of my portfolio has 0 standard deviation. You take the mean here, 55 plus 55 divided by 5, 2 is what? 55 only. The expected value is 55. The sigma is also what? 0. In that case, it is a risk-free portfolio, right or not? A risk-free portfolio should be asking risk premium, should not ask, should not ask. It should be discounted at what rate? Risk-free rate. So I can discount this portfolio at risk-free rate, yes or no? Now can I proceed further? No. So next is I have to calculate the present value of the portfolio. Okay. So, okay, if irrespective of the FSP, portfolio value remains same. From this could be understood that it is a risk-free portfolio unmoved by future events. Can I proceed? No. Step 4 is what? Present value of portfolio. Future value is 55. Discount by how many months? 3 months. At a normal discounting, a continuous discounting, always our chapter uses a continuous discounting. So it is what into what? It is e power r, e power tr means t is how many months? 3 months. 3 by 12 is a term and rate of interest is what? 0.12. We all know that it is 1.0305. So I have to discount by e power tr minus tr. So it is 55 divided by 1.0305 gives you 53.37. Ennappa, accepted or not? No. So the value of the portfolio today is what? 53.37. It is having 1 asset, 2 items are 2 items. It is having a shareholder. Also what? Call writing. From this 53.37, if I knock off the value of the share, what is the balance here? Value of the call. That should be the premium. Ennappa, right or not? No. The present value of delta shares. How many shares I am holding? 0.6111 share. What is the spot price of the share? 100 rupees. So the value of my share today is how much rupees here? 61.11 because if I hold 1 share, my wealth today is what? 100. I hold only how many shares? 0.6111. My wealth is 61.11. Am I right or not? No. So I know the value of the portfolio is how much here? 55.37. Invest the share value is what? 61.11. The balance figure is what? Call value. The value of the call is 7.74. I can understand that you are all somewhat having confusion. So it is not 7.74. It is what? Minus 7.74. I'll speak about the minus later. Everybody following or not? So just call it as what? 7.74. What the value of the call option? 7.74. Up to this binomial model steps. Everybody have that clarity or not? Now, we can also find out value of put option using what equation? Put call parity. Now, I know the value of the call. I know the value of the share. I know the present value of strike price. Can't I find out the value of the put option or not? Now, write down next step. That's not step 7 Lapa. It is only a balancing figure. It is not a binomial model step. Can I proceed? Right now, next step. The value of the put option can be found out. Please. Shh. The value of the put option can be found out using The value of the put option can be found out using what equation? Put call parity equation. The value of the put option can be found out using put call parity equation. The value of the put option can be found out using put call parity equation. Now, everybody, can you proceed or not? Now, for that we have to first calculate PV of X. We have to calculate present value of strike price. Write down. Present value of strike price is equal to PV of X is equal to, if I am right, strike price 97. Now write a number 97 into e power minus T is how many months here? 3 months, means 3 by 12 years, into R is I think 0.12. Now number right? Now 97 into e power minus 3 by 12 into 0.12, which is equal to 97 into e power minus 0.03. Yes or no? And e power minus 0.03, which is equal to 97 into 1 by 1.0305. Already we calculated earlier. Yes or no? 97 into 1 by 1.0305 is equal to how much? 94.13. Yeah? 94.13. Okay, I believe your numbers. 94.13. 94.13. Please tell me the equation. What is the equation? VC plus PV of X is equal to VP plus VS. Is equal to VP plus VS. What is the value of the call we found out? Let's step number 6. What is the number here? 7.74 plus. What is PV of X? 94.13 is equal to VP. We have to find out what is spot price of the share? 100 rupees. Number correct above? 100 rupees. Rearrange it. I'll get value of the put is equal to, please tell me the number net off and tell me. 7.74 plus 94.13 minus 100. What is the number? 1. The value of the put is equal to 1.87. The value of the put option is equal to 1.87. Value of put is equal to 1.87. That's how I found out using what equation? Put call parity equation. Everybody respond. Are you able to understand it or not? No. See, before I go for discussion, let us consolidate by doing one more sum. Let's do what? One more sum. We now know how to do the problem. Yes or no? That should not be a problem. Let's do one more sum and then go for the explanation. Nothing great, very small explanation only. Can I proceed? Now, take the next problem. That is question number 22. Please. Shh. I am not going to do this. You should tell. I'll put the slide. Okay, we are going to do it together. Please. One practice. Okay. Now, take question number 22, second part. Now, all of you participate. Spot price, how much? 100. Strike price, 100. The maturity price can be 90 or 115. Term is 6 months. Interest rate is 10%. This is all the details given. Now we have to find out the value of the call option, and then we can find the put value using what equation? Put call parity equation, balancing figure. Can we start doing it or not? Now let's start doing. Right, question 22B. This is A, B, C and D. I'll give it as what? Homework. Okay, now take question 22B. Okay, write facts. Write facts. Spot price. What is the spot price of the share? How much rupees? 100. Where you can get this number? From the share market. Today the share is trading at 100. Strike price. In the option market there is a contract with a strike price of how much rupees? 100 rupees. Strike price 100. Can I proceed? Now. FSP. What is the future spot price? Tell me what is the future spot price. It can be 90 or 115. Can it be 90 to 93? No. It is not 90 to 115. It is what? 90 or 115. Term of the option. What is the term of the option? 6 months. The term of the option is 6 months. Interest rate is 10% per annum. Interest rate is 10% per annum. Again, remember what the strike price? 100. That you have to remember it. Can I start or not? No. Okay, now write down portfolio. Underline that. What is the portfolio? Hold a call, write a call and hold delta shares. Write a call and hold. It is wrongly typed triangle. Okay, write a call and hold delta shares. Write a call and hold delta shares. Write a call and hold delta shares. Okay. Now, step 1. Step 1. Situation FSP VC. Situation, future spot price and then value of the call. Situation 1. Tell me what is the upper bound FSP in situation 1? 115. 115. Answer my question. If the FSP is 115, who will decide? I will decide or my holder decides? Holder decides. He will exercise or will he lapse? Exercise. He has a right to buy at 100. A share worth what? 150. He is happily making how much profit? 15. For me the call is what? Minus 15. As a writer I have minus 15 as a call value. Can I proceed up? Now. Next. Situation 2. FSP can even become what? 90. Will my holder exercise or lapse? Lapse. So what is the value? 0. Now. Change. FSP changes by how much rupees? 25. The call value changes by 15. FSP changes by 25. The call value changes by 15. Am I right or not? Now, first step over. Step 2, delta shares. You have to participate and do along with me. Step 2 is what? Delta shares. Formula. Delta shares is equal to change in VC divided by change in FSP. Change in VC divided by change in FSP. Which is equal to, I want the number. What is change in value of the call? 15 divided by 25. 15 divided by 25 is equal to 0.6 shares. Delta shares is 0.6 shares. Right below that, our portfolio is, right? Our portfolio is, can I now define the portfolio fully? Our portfolio is what? Write one call option. Our portfolio is write one call option, and hold, how many shares? 0.6 shares. Write one call option and hold 0.6 shares. And hold 0.6 shares. Can I proceed or not? Now, step 3. I forgot. What is step 3? Future value of portfolio. Step 3, future value of portfolio. Future value of portfolio. Situation number, FSP, share value, VC, portfolio value. Situation number, FSP, share value, VC, and then portfolio value. Can we start or not? Now, situation 1. FSP can be what? 108. Sorry, 115. FSP can be 115. If I hold one share, what is my will? 115. I am holding only how much? 0.6 shares. So my share value is 0.6 into 115, 69. My share value is 69. Will other party exercise the call or not? Yes. Due to which my call value is minus 15. Already in the previous step, my call value is minus 15. If I add, what is my portfolio value? 54. The portfolio value is 54. Situation 2. FSP is 90. FSP 90. Share value is 0.6 into 90, 54. Share value is 0.6 into 90, 54. What is the value of the call? 0. It is lapsed out of the money. Call is always worthless. It is what? 0. What's the portfolio value? 54. Portfolio value 54. Now, Whether the FSP is 115 or 90, whatever may happen, my portfolio is always worth what? 54. Is it a risky or riskless portfolio? Riskless portfolio. This is a value today after 6 months. After 6 months. If you want to find out the today's value, you have to discount by 6 months. Using what rate? Risk-free rate. Now step 3 or step 4? Step 4. Present value of portfolio. Present value of portfolio. Present value of portfolio. 54 into e power minus 0.10 into 6 by 12. Now T is 6 months now, 6 by 12 years. R is what? 10% given. Right or not? 54 into e power 6 by 12 into minus 0.10. Now, which is equal to 54 into e power minus 0.05. 44 into e power minus 0.05. Now, can we do the e power minus 0.05 calculation? Right now, next. E power 0.05 is equal to, please, let us do it together here. Don't be ahead of me. E power 0.05 is equal to, write the calculation, is equal to what? 1 plus 0.05 power 1 by 1 plus what? 0.05 square divided by 2 plus 0.05 cube divided by 6. 1 plus 0.05 by 1 plus 0.05 squared by 2 plus 0.05 cube by 6. I want a number. What is the number here? 1.05. 1.05? Number is 1.05. 12. Okay, this number 1.0513. 1.0513. E power minus 0.05 is equal to 1 by 1.0513. Now, what is 1 by 1.0513? Tell me the number. 0.9512. 0.9512. Now, just for the sake of checking, last time can just check it. Look at the table which you have at the back of the workbook. Yes or no? Just to get familiar with the table also, I am just telling you now. X is 1.05. What is e power 0.05? 1.05? 127. We round up to what? 1.0513. And what is the number? 0.95123. We wrote as what? 0.9512. Can we proceed or not? No. Right now, present value is equal to, all of you do along with me, present value is equal to 54 into 0.9512. 54 into 0.9512. 54 into 0.9512. Or 54 into 1 by 1.0512. Some number. Tell me what is the number you are going to get? 51.37. I will spell 51.37. 51.37. Everybody having the clarity or not? Now, what is 51.37? Present value of the portfolio. Now, please all of you tell me, next step is what? Present value of delta shares. Right now, next step 5, present value of delta shares. Step 5, present value of delta shares. Okay, stop writing. What is the value of one share today? Spot price. What is the value of n shares today? Spot price into number of shares. Same way. Okay, write down. PV of delta shares is equal to, present value of delta shares is equal to, Idam we call as delta hedging. We will be studying in the Greeks once again. A Greek letter called as delta. Okay. Present value of delta shares is equal to what into what? Delta shares into spot price. Present value of delta shares is equal to delta shares into spot price. Which is equal to what into what? 0.6 into 100. Spot price 100 or 0.6 into 100. Don't get confused. Strike price also is what? 100. What I'm writing here is spot price. Okay, 0.6 into 100 is equal to how much rupees? 60 rupees. Is equal to 60 rupees. I know the portfolio value. I know the share value. The balancing figure is what? Call value. Step 5 or step 6? Step 6. Step 6. Value of call. Step 6. Value of call. Value of call. Write down. Present value of portfolio is equal to, present value of portfolio is equal to value of the call plus value of delta shares. Present value of portfolio is equal to value of call plus the present value of delta shares. Value of the call plus present value of delta shares. I know the portfolio present value to be, tell me the number, 51.37. 51.37 is equal to, what is the value of the call to be found? What value of delta share? 60. Value of call is equal to 60 minus 51.37. What is the number? 8.63. Value of the call is equal to 8.63. Value of the call is equal to 8.63. Now how to find out value of put? Put call parity equation. Write down next step. We can calculate value of the put using. We can calculate value of the put using. We can calculate value of the put using put call parity equation. We can calculate value of the put using put call parity equation. Then calculate value of the put using put call parity equation. Okay. Shall I proceed or not? Now. First of all, what should I calculate? PV of X. That right? PV of X is equal to present value of strike price is equal to strike price into e power minus TRF. Strike price into e power minus TRF. What is strike price? 100. Am I number correct? 100 into e power minus, what is the term? 6 by 12 into 0.12. 100 into 0.10. E power minus 6 by 12 into 0.10, which is equal to 100 into e power minus 0.05. We need not do anything great. Already calculated 100 into what is e power minus 0.05. We found it here now 0.9512. 100 into 0.9512. 0.9512 is equal to how much? 95.12. The present value of strike price is 95.12. Please, next. VC plus PV of X is equal to VC plus PV of X is equal to what plus what? VP plus VS. VP plus VS. Now, what is the value of the call we found out? Tell me. 8.63 plus 95.12. Enapa number correct? PVX is equal to VP plus what is the value of the share? 100. Short price is 100. Rearrange. VP is equal to how much? How much are you going to get? 3.75. Value put is equal to 3.75. Value put is equal to 3.75 or 3.76 as the case may be. Everybody yes or no? No. With this, we have completed how to solve a call valuation and put valuation using what model? Binomial model. Let us just ask some discussion for understanding the model, how they develop this model, and then we can just go for the next area called as risk neutralization model. Okay, now please. Shh. Okay, now the main problem for the valuers is the discount rate. Discuss now. I should discount at what? Risk-free rate. But the problem is, if I straight away start discounting the option cash flows, the cash flows are what? Uncertain. I cannot discount at risk-free rate. Enna parita? Please tell me, yes or no? No, no. See, our portfolio, put call parity portfolio different. In put call parity, what is the right hand side? Hold a share, hold a put. Now, this is a different portfolio. That is what? A different portfolio. I cannot use this portfolio for what? Using a put call parity is altogether a different portfolio. Understand or not? So, we should not use the delta share. Put call parity should not be touched. Very sacred. Yes or no? It is already derived here. Can I proceed not? Now, please. Why you are talking? Can I proceed? Now. What was the problem? What is the problem? Tell me. In our class, talking problem, yeah? For valuation, what is the problem? Tell me. Discount rate. The main problem is what? Discount rate. Please. Shh. Because option should be discounted at discovery rate. Everybody asking a concurrence. The concurrence is because it raises the value only from what? Underlying asset. Since the underlying asset has been already discounted for risk, I should not discount once again the option cash flows for what? Risk, because they will be considered risk 2 times. Are you following what I am saying? So we all feel in the heart that we should discount at what rate? Risk-free rate. Problem is, option cash flows, they felt it's difficult to discount straight away at what rate? Risk-free rate, because the cash flows has a standard deviation, 11 and 0 in the last problem, and this one I had what? 15, 0, etc. In that case, the cash flow has sigma, but I have to use what? The risk-free rate. What is the option out? Yes or no? No. So what they did is, they constructed in binomial model a portfolio. They constructed what? Portfolio. This portfolio is what? Risk-free portfolio. So they constructed a portfolio which happens to be what? Risk-free. They discounted the portfolio back. Discounted what? Portfolio back. When they discounted the portfolio back, inside the portfolio, share is that, take that value out, the balance is the option value. Respond. Are you following or not? That is, they did not value the option separately. They valued the option along with what? A share also in the portfolio. Everybody follow what I am saying? They constructed a portfolio which is what? A risk-free portfolio. The portfolio consists of share as well as what? The option. Okay. So in that case, what happens is, from the portfolio value, if I knock off what? The share value, what I get is what? The option value. So here itself we can know that option is a derivative, because what value the option takes depends on the value of the share. The share value is more, now option value becomes what? Much more or less. Depends on call option or put option. We'll discuss that later in Black-Scholes. Understand what I'm saying? But understand that portfolio value is a riskless portfolio value, in that share value is what? Independent. It is done in the share market. Take it out, the derived value. What value? Derived value. Not the original value. What value? Derived value is what? The option value. Tell me, option is an asset on its own, is a derivative. It does not have a value on its own. It derives the value only from what? The share value. Everybody, are you following what I am saying? So this is called as a derivative instrument. Yes or no? Now, if I say in the first class, derivative instrument derives the value from what? Underlying asset. It's a very general statement. People may not be able to visualize it. Are you following what I am saying? But now are you able to understand that the real option value comes only from what? The value of the share which is underlying in that option. I think I have the clarity or not? Okay, now the 2 question is, number 1. Sir, how said this portfolio is what? Riskless portfolio. That proved already, but still we have to see why this is what? Riskless portfolio. Normally we heard call one share, one call, one share. Why we have a call and then what? Delta shares. What is so great about this? Delta shares also should be known. Are you all following what I am saying? Finally, in the step 6, we wrote 7.74 as a call value in what? First problem. And this problem has what? 8.63. Really, it is not 7.74. Mathematically, number is what? Minus 7.74 or minus 8.63. How to interpret the negative? That's the next issue. Yes or no? When I complete these 2, I'll give a notes for this. Then we can just complete the binomial model before we go for the next one. Can I proceed or not? Now, see. Now, I am having a portfolio where I write a call and I hold a share. I hold how many shares? I am holding share. I am what? Writing call. Yes or no? That means I have 2 positions. One is I am a writer of a call. I am what? Holder of a share. How many shares? Forget it. I am a holder of the share, writer of a call. Okay. Now, see. Tomorrow on maturity date, only 2 things can happen. Share price can increase, share price can what? Decrease. 2 things here. Increase in share price. Next is what? Decrease in share price. Okay. You will tell me a news, I should react. You should watch my face. I am not good at acting, yeah? I'm just saying through words, okay? When a person tells a news, you can know how the other party feels by reading the face. Now, see what happens is, you come to me and say, see the share price has increased. The share price has what? Increased. Tell me, I'll be laughing or crying. Share price has increased. I'll be laughing or crying. First instant is I'll be happy because I'm holding a share, the share price has increased. So I am happy. I put H for what? Happy, and C for crying. Yes or no? So in that case, I'm very happy because the share price has what? Increased. I'm holding a share, my wealth increase. Yes or no? Immediately thought of another party called as what? Holder. Immediately started crying. Why? Because I return a call here, he'll exercise it. Yes or no? I will losing from what? Call option. So I'll be what? What a cry on UH means what? Unhappy by call writing. Yes or no? No. So when you tell me the news, I will laugh as well as what? Cry. I laugh as well as what? Cry. Okay, now. Okay, now. Because in this portfolio, I will laugh as well as what? Cry. When the share price increases, I'm happy as a shareholder, unhappy as what? A call writer. Please. Shh. Similarly, when the share price decreases, very happy because my holder will lapse. I escape. In that case, I am happy because of what? Writing a call option. Why am I unhappy? Because I am holding a share, that value what? Declines, and unhappy due to what? The shareholding. Respond yes or no. That is, the portfolio consists of items in such a way that it makes my portfolio stable. I am neither happy, I am not what? Unhappy. I am stable because one thing offsets or compensates the other. Everybody follow what I am saying? So, that is why the portfolio, write a call, hold a share. Write a call what? Hold a share. This is point number 1. Right or not? Now, the next point is, sir, then the portfolio should be write a call and hold a share. Yes or no? Why the portfolio is what? Write a call and hold the delta shares. In a question, yeah, right or not? So the portfolio is not write a call, hold a share. The portfolio is what? Write a call and hold delta shares. Shall I proceed? No. First of all, why write a call, hold a share? That you are following or not? Then only when share price increases, happiness comes from shareholding, unhappiness from what? Writing. Share price decreases, happiness comes from what? Call writing, and unhappiness comes from the shareholding. Anyhow, these two are going to compensate each other, leaving a portfolio stable, hence this portfolio. I don't know. Then the question is, sir, one call, one share, that is going to be much more better. Na? Why don't have a portfolio, write a call and hold one share? Why should I have write a call and what? Hold a delta shares? Is the next question that may arise. In the parida not now. Look at this, please. Okay. Problem number 2 itself, let us take it. Look at the step 1. See, when the call value changes by 15, the share value changes by 25. Enna paridana? Yes or no? That is, in other words, to tackle the loss due to call, I need not hold one share. It is enough if I hold 0.6 shares. Did you understand or not? Please. That is, if I hold one call and then what? One share, tell me, due to the call, that is when the share price increases, I am unhappy of holding a call because it's going to give me minus 15. Yes or no? The two share prices only understand that it can either be 90 or what? 115. When the share price is 115, when the FSB is what? 115. Look at the next slide. I am going to be happy as well as what? Unhappy because it become 115. I am happy because my share now which I bought at 100 has become how much? 150. I am happy as a shareholder. Yes or no? I am unhappy as what? Call writer because I suffer what? 15 loss. Now, please carefully follow that. To offset the 15 loss, I need not hold one share. I need to hold only what? 0.6 share because when the loss is 15 from a call, the share price gain is 25. Share price gain how much going to be? 25. So, in that case, to tackle the change, it is 15 by what? 25. If I hold 0.6 share itself, I will be able to what? Tackle this particular number of 15 change. Are you follow what I am saying? So, again I repeat. See, I am holding, right? I am writing one call. Due to writing a call, I am going to suffer a loss. When the share price what? Increases. To offset that loss, it is not necessary that I should be having what? One share. It is enough if I am going to have what? The 0.6 shares, because the proportion of the call volatility to the share volatility is not 1, it is only what? 0.6. For 15 rupees change, the share price volatility is how much here? 25. The volatility is 25 for what change? 15 rupees change. In such a case, 15 by what? 25. This is what I expect now. All these are what? Expected changes. The change can be either 25 or what? 15. 15 to 25 ratio is what? 0.6. Hence I hold the delta shares. If I hold delta shares only, my portfolio will become what? Stable. If I hold one share, let us see what happens here. This becomes what? 115. Get about? And this is what? Minus 15. What will be the number here? 100. If we hold one share, there becomes what? 90. And this becomes what? 90. So the portfolio value may be 90 or what? 100. It becomes a risky portfolio. I don't know, to make it riskless, I need not have one share to tackle the call value. I need to have only what? 0.6 share to tackle what? The call value. Now, the reason is also very obvious. The reason is, call value cannot become positive for me. Yes or no? Suppose, in this case, 90, he has to surely buy. What happens here? Then, I am going to sell at what? 97. A share worth what? 90. I will be having someone here. Everybody following what I am saying? See, again I repeat. Holder of a call has a right to buy at 97. Suppose the share becomes what? 90. If it is a forward contract, not option, is what? A forward contract. He is also buying that. In that case, he should buy me at 97 rupees or not? Yes. In that case, I will buy from the share what? 90 at what? 97. It will give me 7 rupees profit. In that case, then it will be what? Exactly equal. Are you following what I am saying? But now it is not possible. Why it is not possible? The reason is, I am holding what? An option. Okay. Option will not allow you to go towards the negative side for a holder. So it stops at what? 0. That means, look at this. For 15 rupees change in value, I have to tackle with a 25 rupees share price. I need not hold one share. It is enough I hold what? Delta share. This is because delta hedging. What is what hedging? Delta hedging for a share. Are you following what I am saying? So now, this is number 1. Why should I have this portfolio? Number 1, this portfolio is what portfolio? Risk-free portfolio. From a risk-free portfolio, I can discount at risk-free rate. How this portfolio is a risk-free portfolio? Because if I am happy as a writer of a call, I will be unhappy as a holder of a share, and vice versa. Happiness and unhappiness exactly offset each other. And the next issue is, for tackling a 50 rupees call change, I need not have one share. It is enough if I have what? 0.6 share. The share change is 25. The call change is only what? 15. So to tackle a 15 rupees change, 0.6 share is what? More than enough. That is proved through what? The other number details or calculation. Please tell me, everybody following on? This is point number 1 we have discussed. Can I proceed to the next point or not? Now, next. Look at the last step, step number 6. Now, my portfolio value 51.37. Yes or no? My portfolio value, how much rupees? 51 point? My portfolio value 51.37. My share value is what? 60. Yes or no? Yes. Portfolio value itself is 51.37. Is a combination of asset. One of the asset value is what? 60. Then the call value should be minus 8.63. Respond yes or no? Yes. How to understand that minus 8.63? Very simple. Now, tell me, you are a holder of a call, writer of a call. Writer of a call is having a right or obligation. Obligation is an asset or liability. It is only one liability. You will never earn any money from it. Call option writer will not earn anything from the call, because if something is favorable to him, the other party allow it to lapse. He will not make that is loss. The holder will not make what? Loss. The writer has either to suffer the holder's loss or what? Have zero payoff. Writer can never make a money from an option. Yes or no? He is not a person who is having a right, as a person having what? Obligation. Obligation is a liability. Yes or no? No. Very simple. Had he held the share alone, his wealth is 60. Due to having a share and writing a call, his wealth has become what? 51.37. Due to call writing, wealth has eroded or not? That erosion in wealth only is asked as premium. He should ask a compensation for taking the obligation or not. The erosion in wealth only, he should be asking us what a premium. He said, look at this, I am 60 rupees wealthy. Yes or no? Due to you, holder only, my value has become what? 51.37. Due to you, I have lost how much wealth? 8.60. That you pay us what a premium. That's the matter. Are you following what I'm saying? So it is negative only. I don't deny. The call option erodes the wealth by how much base? 8.63. It is a liability. Tell me what is a net worth? Account, what is net worth there? Asset minus liability. Portfolio is a net worth. I have an asset called as what? Share. I have a liability called as what? Call. In that case, net worth is what? Asset minus liability. Where I know the net worth, I know the asset, I know the liability is how much? 8.63. So this liability, if I have to undertake, I should charge you how much it is? 8.63. Nobody does any obligation for you free of cost. Either premium discount for this option. This one is or no? Now, that means we have accurately valued the option or not? Now, we have valued the option. Then, you cannot say that, sir, then why the holder should have it, why the writer should have it. Understand that this value we have arrived by assuming that FSP can be 115 or what? 90. Okay, now somebody may be having another view saying that FSP can be either 130 or what? Say 80. He may have other view or not, because both of us can have different view of the share, right or not? In that case, for you the call may be what? 8.63. For another person the call may be what? 10.76. He feels that you are underpricing. He'll be what? Buying from you the call option, yes or no? And I feel that he is overestimating. I'll be selling at what? 8.63. Always market will move. Only there's a difference in perception. Are you following what I'm saying? So, for both of us, we have given a model for valuation. So no. Now, input data yours. Input data is what? Yours. You can say 115 and what? 90. I can say what? 125 and what? 80. We have difference in opinion of what? FS base, but both of us have a model to value. Both may have one model to value. Your value may be different. My value may be what? Different. You can become a holder. I can become what? Writer. All are perceptions, but both have a model to value. That model is, first model is what? A binomial model. Share valuation is same thing only. So what is the value of the share? D1 by KE minus C. One valuation. What is the value? Dividend growth model. Now, I have a model here. You may perceive different dividend from the company. I may perceive what? Different dividend from my company. Input data is ours. Nobody can value any asset in the world. It is as good as valuing a god. What is unknown can never be what? Valued. But people perceive. It's what people want to perceive. Input data is yours. Model is mine. Are you following what I'm saying? Mine or not mine, yeah? Model is what? Person who has told it, okay? In that case, input data is yours, model is what? Mine. If you have an input data, I have a model for you to value. Everybody follow what I'm saying? And how good is the value depends on how we have arrived at what? Input data. If you are good at forecasting, you are very great. Otherwise what? You are not so good. Everybody are you following what I'm saying? Valuation, all asset, that is what is going to be what? Valued. I don't say this is a correct value, that is wrong value. Nobody can do a value judgment. Nobody can do what? A judgment in value, but people can judge what? The model used in what? Valuation. How good is a value depends on how good the input factors are into the model. Are you following what I am saying? So now, have you understood the negative number or not? So tell me, what is minus 8.60? Explain me. This investor, due to rating of the call, is suffering an erosion of 8.60 rupees in his portfolio value, which is what is asking the holder as what? Premium to be paid for the call option. Is the meaning of that. Everybody, are you following what I am saying? This is a discovery of the call value or call premium. Obviously, we know the call value. We know what? Share value. The put should necessarily have what? The other value. If it is have a different value, put call parity exists, people can jump and make arbitrage. Everybody, are you following what I am saying? So this is how we should be valuing the call option and put option using what model? Binomial model. In a response, yes or no? Can I have a small notes in this regard or not? Just a minute, but shh. Stop talking. Stop talking. No. That I am saying here. Now, two values, for example, 115, 19. I never use the word extreme value. I never use the word what? If I say extreme value, something in between also possible. It can either be 90 or 120. Model name what? Binomial. Sir, it can be 18, 90 to what? 115. Then you have to go for a different model. Yes or no? From here the model starts what? Developing. Is either up and what? Down. Don't say extreme. Upper value, lower value. It is not what? Extreme value. In between value also will be what? Accepted. It cannot happen. Prediction. Prediction, yeah? Okay, now. Please, these two values are what? Predictions only. You can have a different two values, you can have what? Different two values. Your value of call differs from me. Are you following what I am saying? It is only a prediction. Okay, please. Shh. Can I proceed? Any doubt about? Super. Who said? Because I am going to write 100 calls. How many calls? Yeah, 100 calls. Have 60 shares. You make it into what? Lots here. Make it into what? Lots. But I cannot round down this points because accuracy will be lost. You know what I am saying now? If they are not getting 0.6 shares, do it in what? Lots. Unless it becomes what? A rounded off number. Now. Huh? Okay, I have to do only in lots, obviously. Make a 0.6 shares not possible. Now I have to buy in what? Hundreds of lots. We will be getting the number. Okay. Suppose share is traded only in hundreds of units. Okay, in that what do you do? Write 1000 calls and have what? 600 shares. So, but the model will not change. It cannot go for the market intricacies. It only gives you have to tailor it to what? The market requirement. Okay, now please. Shh. Doubt can I proceed? Now we have to complete here. Write down notes. Please. Shh. Now, don't talk. No. Yes, switch on, switch off. I am indifferent here. Nothing is going to come to me. Can I switch off? Yes, write down notes. Point number 1. Point number 1. Before that, option valuation model, any notes given? After put call parity, notes given or not? No. Let's have that notes also continue with this. Okay, right? Point number 1. In the earlier segments, we discussed about the minimum and maximum values of the call and put. We discussed about the minimum and maximum values of options. We discussed about the minimum and maximum values of the options, the values that should satisfy what? Put call parity. The values that should satisfy the put call parity. But we did not have any model that helps us to value the option. But we did not have any model that helps us to value the option. That helps us to value the option. Here I say minimum, maximum, everything we said. What is the value? Somebody asked me, we didn't have the model to what? Value the option. Point number 2. In this segment, we will discuss the option valuation models. In this segment, we will discuss the option valuation models. Which are the option valuation models, which are A, binomial model, B, risk neutralization model, C, two-period binomial model, two-period binomial model. D. Black-Scholes model. D. Black-Scholes model. D is Black-Scholes model. Black-Scholes model. Blackscholles, Black-Scholes model. Can I proceed? Next point number 2 or 3? 3. Value of an asset is present value of future benefits. Value of an asset is the present value of future benefits. Value of an asset is the present value of future benefits. Value of an asset is the present value of future benefits. Similarly, value of an option is value of an option is what? Present value of its future benefits. Similarly, value of an option is the present value of its future benefits. Is a present value of its future benefits. Can I proceed? This is normal, any valuation. Okay, point 3 or 4? 4. The main problem in valuing option is the discount rate selection. The main problem in option valuation is the discount rate selection. The main problem in option valuation is the discount rate selection. Now, 1 minute, I just forgot to tell you one more angle, the discount rate selection, and then proceed. See, this formula is very famous for call option and put option. What the call option value? Spot price minus present value of strike price. The value of the call. Rumba simply, a call holder will get the right to buy at what? Strike price. And today he can sell at one price, spot price, and do short selling. The difference I can get the value from the call. Innappa right or not? Now, rumba simple. Yeah. If you don't understand this formula, the discussion I am making for you to have clarity. Are you listening or not? Now, leave this formula. Now, you are a call option holder. You hold a call to lapse or exercise. Okay. Now, on the maturity date, what is the share price? FSP. What is the strike price? X. The value of the call is FSP minus X. Is accepted? Yes, this is the value of the call today. After 3 months. What is the value of the call today? It's present value. Yes or no? Now, what is the present value of FSP? Spot price. What is the present value of strike price? PV of X. Gives the value of the call today. Please respond, yes or no? Now, see, you are a call holder. You are what? Call holder. Why you pay premium to buy the call? To exercise the LAMSA? Exercise. I will exercise when FSP more than strike price. So no. Now, on the maturity date, what is the benefit the call is going to give you? It gives me a right to buy a strike price. A share worth what? Higher value. So FSP minus X is the benefit I earn from the call. Yes or no? For that benefit only I pay the premium today. The premium is the present value of that benefit. Yes or no? Now, please discount it independently. Discount the future spot price. Today is going to be what? Correct? Now, I discounted what? KE. I don't discount at what? RF. I discounted what? KE. The share worth 150 rupees after 3 months is 100 rupees today. The discounted should be what? The risky rate. So it becomes what? Spot price. So no. And this should be discounted what? Risk-free rate. Because it's what? Agreed price. In that case, now tell me, spot price have a discounted for risk or not? The spot price is a present value of the future benefit. That is discounted for what? KE. Spot price is already discounted for what? Risk. So whenever I value the call, I should not discount. This cannot be discounted what? That is not discounted what? KE, because already spot price when I take is discounted for what? Risk. One thing we should know that the option derives a value from what? Underlying asset. This is an agreed amount. It derives value from what? Underlying asset. Underlying asset value is already discounted for what? Risk. I should not use once again what? And discounted for discounting the option cash flow. Now, but the dilemma is very great because it can be FSP minus X also can become what? 0. But this cannot be discounted risk-free rate because in that this cash flow is risky. This number and this number is not same. Why it is not same? FSB changes. Yeah, correct. FSB what changes? I cannot discount straight away the option cash flow using what? Risk-free rate. The problem is the cash flow are risky. Yes or no? I cannot discount at KE because in that case this X also be discounted at what? KE, but they give me an agreed price. Yes or no? That means I should find out the modus operandi where I should use what? Risk-free rate. Also, I should not look abnormal in discounting risky cash flow at what? Risk-free rate. That is what the models try to find out. Different angles on them, right? Are you following what I am saying? So, now what I discussed here? The main problem in valuing the option is the discount rate selection. Continue. It is agreed that the option derives value from. It is agreed that the option derives value from. It is agreed that the option derives value from what? Underlying asset. It is agreed that the option derives value from underlying asset. Full stop. While valuing underlying asset, the risk is already discounted. While valuing underlying asset, the risk is already discounted. While valuing underlying asset, the risk is already discounted. You able to understand or not? While valuing underlying asset, the risk is already discounted. Hence, while valuing option, we should not discount the risk once again. Hence, while valuing the option, we should not discount the risk once again. While valuing the option, we should not discount the risk once again. We should not discount the risk once again. Thus, we always use, everybody tell me, we always use what? Risk-free rate. Thus, we always use risk-free rate for option valuation. Thus, we always use risk-free rate for option valuation. Everybody following or not? Next. Point number 5. Risk-free rate can be used. Point number 5. Risk-free rate can be used to discount only those cash flows. Risk-free rate can be used to discount only those cash flows. Risk-free rate can be used to discount only those cash flows that has what? Zero standard deviation. Risk-free rate can be used to discount only those cash flows that has zero standard deviation. But option values differs. DIFFERS, option value differs. For example, in the part B question, the option value can either be, what? 15 or 0. The option value can either be 15 or 0 after 6 months. The option value can either be 15 or 0 after 6 months. So, always context understand. Here when I say value, I mean what value? Future value. The option value can either be 15 or 0 after 6 months. And if we say the expected value is average, and if we say the expected value is average. So when something is 15 or 0, we expect extremes average or average. And if we say the expected value is average, it will have standard deviation. If we say expected value is average, it will have standard deviation. If we say expected value as average, it will have standard deviation. And hence cannot discount using. It will have standard deviation and hence cannot discount using. And hence cannot discount using what? Risk-free rate. And hence cannot discount using risk-free rate. And hence cannot discount using risk-free rate. Using risk-free rate. Everybody following not? Now, all this is a very profound discussion here. How the valuation models have what? Evolved. Are you following what I am saying? You can discount using the risk-free rate. Can I move to the next point or not? Now. So now tell me what is my problem? Yeah. I should discount using what? Risk-free rate. I cannot also discount using what? Risk-free rate. Because I should discount using risk-free rate because option value derives the value from what? Asset is already discounted for risk. So now, why can't I use risk-free rate? Because the option value deviates. It can be 15 or what? 0. No certainty. The expected value of that call cannot be discounted using what? Risk-free to find out present value because it is having a standard deviation. That is why so long people are not able to understand the valuation. Yes or no? Now, it took so many years to crack this particular jinx in valuing an option. Are you following or not? Next. Point number 3 or 4 or 5 or 6? Point number 6. Point number 6.